The idea of offloading risk while holding on to the underlying loans using credit default swaps, or CDSs, was pure gold for banks. The next step, step number 2, was the development of a supercharged form of CDS, which came to be known in bankers' jargon as CDOs, or in English, collateralized debt obligations, to contain bundles of collateralized debts from a diversity of different debtors whose default risks were to be offloaded. Although the initial idea had been to offload the risk of debts owned by the bank or other entity issuing the CDS, the practice soon developed of including debts owed by independent banks or other entities other than the issuers of the CDOs. In the obscure jargon of Wall Street, these came to be known as synthetic collateral debt obligations, or synthetic CDOs.
J.P. Morgan had struck gold. In 1998, they decided to ramp up their credit derivatives operation. That year, another young banker joined the team, Terry Douillon.
Part of my job was to come in as a trader and to build a credit derivative trading book, including all the risk management around the more exotic products. That was what I was brought in to do.
Previously, J.P. Morgan had written credit swaps on single companies like Exxon. Douillon was asked to write swaps on bundles of debt.
The idea was, let's put together a portfolio of credit risk, a portfolio of names.
Her first trade was a credit default swap on 306 corporate names on J.P. Morgan's books.
And that list of 306 entities, they were very highly rated. They had very low credit risk.
And the credit default swap was ensuring J.P. Morgan against default by those 306 entities.
That's
many
correct.
of them Fortune 500 companies or other.
It would have been some of your most well-known household names. And so we were giving investors an opportunity to, in effect, invest in our loan portfolio.
J.P. Morgan did a lot of work, did a lot of diligence to assemble this portfolio of loans. And you can get it in one easy, bite-sized piece.
And the bank facilitated this by slicing up the portfolio into different risk levels or tranches. Investors could choose how much risk they were willing to take.
Different investors wanted different levels of risk. There were some investors that wanted to earn a big return on really risky stuff, and there were some investors that wanted to earn a little return on stuff that wasn't risky at all.
From there, the bank looked to expand their business even further.
So along comes this idea. What if we could create a market where people were able to buy and sell freely, independently of the companies themselves, the risk associated with lending to those companies?
And so they began selling derivatives that were simply bets on any and all portfolios, whether the bank owned them or not. These products came to be known as synthetic collateralized debt obligations, synthetic CDOs.
There were investors who were able to invest in some entities that they had not had access to before.
By buying a credit default swap.
By investing in a credit default swap because it was a name that they hadn't previously had access to. So there was a lot of very positive reinforcement of the market, and it just grew. It grew very naturally. Once the seed was planted, there wasn't any stopping it.
It was the beginning of an unfettered, brave new world of banking.
This was pretty new stuff.
This was incredibly new stuff. It was amazing. It was clearly a product that was in need. We had identified a need.
Most of the members of the global derivatives group at J.P. Morgan were in their 20s, including Masters and Duyon. But with the creation of the credit default swap market, they had made banking history.
What in the long run this all meant was that credit, which is a vital part of the lifeblood of any economy, the global economy, became a more readily available asset. And the thinking was that that would be an unambiguously positive thing. Credit helps drive growth, helps companies deploy capital, helps employment, etc. It wasn't any longer just an idea in a room in Florida, it was the creation of an entire marketplace.
Risk could now be easily traded. It fueled a worldwide credit boom. Soon, other banks got excited about the money to be made writing credit derivatives. Paul LeBlanc was a derivative salesman at Morgan Stanley who remembers the pressure to get more deals done.
The volume of transactions was just exploding. I mean, I used to know all the statistics because they used to talk about it every meeting, how this is a growing market, you have to get your customers involved.
You can see the NASDAQ getting a nice...
They can make money, we can make money.
Stanley, a whopping 17...
It was a massively important sector for us to focus on, derivatives.
And importantly, it was a private market, unregulated and out of view.
See, unlike an exchange-traded market where all the banks can see all the positions, there's no public market for these derivatives. You can't look in the newspaper and get a price for them. These are all private, off-exchange markets, and nobody else in the market knows what's going on.
And because this market was opaque, the spreads, the difference between what banks could charge for derivatives and what it cost to provide them, could be huge.
How much were these things making for the bankers that were selling them?
The spreads on derivatives are several times larger than on comparable cash securities, just as a general rule. And that's why the banks trade them.
Cash securities being those that
equities, bonds.
Well, paint some picture of that and the kind of money that people were making.
The best reference that you could give is that if you look at, say, the spread that a bank might earn doing an IPO for Facebook, they're going to maybe make 1% to bring out that IPO, very hot IPO. If you were doing the same size deal in a derivative security, you might make 10 times the fee.
And the basic business that they created was immensely profitable. But there's a problem with all of this. Most people in finance assume risk can be eliminated. But all you can do is move it around from one party to another party.